I'm Mark Molinas, a partner in our corporate practice at Allens, and I'm co-head of our private equity team. Last month, we released our 5th edition of the Private Equity Market Wrap, where we look back on the year just gone and look forward to the year coming. I think last year was an exciting year for private equity and a fantastic year for M&A in this region. It was one of the biggest years in the last decade. PE found itself increasingly in competition with corporate buyers as the corporate buyers really tap the market for growth through bolt-on acquisitions, etc. That said, they held their own. There were some fantastic acquisitions, particularly in the healthcare, education space and also infrastructure space, where we're talking about financial sponsor buyers. It was also a good year in terms of the mega private equity transaction. I think it was probably the first time in a number of years we've seen them back. And by that I mean those really large transactions where a consortium will go off and buy some significant corporate assets. There are various reports that say there's in excess of $1 trillion US in private equity dry powder, or basically money that's been committed to investment. I think a lot of it's held in the US, but we're increasingly seeing large amounts of capital held in Asia. And obviously Australia is well placed to take advantage of that. It has a great investment environment. Regulation is largely well understood, and the opportunities presented by what is otherwise a smart nation at the cutting edge of things like healthcare and education, I think present real opportunities for some of that foreign money to be deployed and put to work in this country. I think the real opportunities for 2016 are those parts of the Australian economy which we are really good at. Australia is fantastic at healthcare, and that dovetails well into this ageing population, not only in Australia but globally, and also education. We quite often hear the pollies talk about Australia being a smart nation and how we do things differently. So there's some real opportunities in early learning and student accommodation in particular. I think this is a really exciting area and one that private equity is really well placed to take advantage of, and that is opportunities where we can leverage technology in industries like consumer, so for example e-commerce, and improving that interface with the customer. Also, other examples would be the use of big data and analytics, and how we can take traditional businesses and actually mine them for new products that can be then on-sold. I think it's another sector that Australia is well placed in, and that's food. And I think there are a number of assets that look like they will be sold. These are current assets held by private equity. For example, it's widely reported that Tegel Foods is in the process of an IPO, and also the Ingham's poultry business, which was bought by TPG back in about 2013. You could foresee that coming on the sell block in the next 12 to 18 months. But this is again that sort of industry that plays well to Australia's strengths, the quality of our produce, the quality of our systems, and obviously we have fantastic markets at our doorstep in Asia, and I'm sure those assets, and in particular that sector, will interest our friends in Asia. Again, I think this is really an area for them to continue doing what they're really good at. And there are a couple of things that spring to mind here. The first being the ability to just access the debt markets globally, a low cost of funds, and just being savvy with the structuring of the capital on any entry. There are some new capital providers coming onto the system, Chinese banks, other alternative capital providers and superannuation funds, and I think private equity are very smart and good at leveraging those markets. I think it has been such a fantastic run for private equity in Australia for the last 3 or 4 years, exiting their investments, whether it's through IPO or trade sale. Obviously, Dick Smith was an IPO, so it's really important to point out that whilst Dick Smith collapsed, it was in public hands, it wasn't in private equity hands. Look, I don't think it will stop I suppose the opportunities that present themselves to PE and really hinder private equity exits in many ways, really. I think as long as the asset is a good asset, it's marketed well, so if you're doing an IPO, it's well marketed. Sure, there might be more testing around things like the financials, but what we're seeing increasingly being very common in this market is for the private equity sponsors to retain an equity stake in the investment, and there are many examples of the second chunk of that investment when it is time to sell, being sold at a premium to the IPO float price. So I don't think it will dampen the activity in a big way.